is Tricolor and First Brands, along with the losses in the job market, especially even the establishment surveys showing that we have negative monthly payrolls back in June, very very likely negative payrolls in across the summertime. And is this really the tipping point where we start to really reevaluate and look at and take a closer look at everything that's been happening over the last couple of years? Is it finally reaching that point where we start to really ask some serious questions?
On this episode, I have the pleasure of welcoming back popular guest Jeff Snider. So Jeff is at the forefront of modern money and monetary science, specifically the Eurodollar market and its impacts globally. He's also the host of the Eurodollar University. So Jeff, thanks so much for coming back on the podcast.
Oh, it's my pleasure, Anthony. Good to see you again.
Yeah, looking forward to the conversation. I think we spoke 6 months ago, and yeah, a lot has definitely changed since then. It's I think it's felt like years since we last spoke. But yeah, I'd be really interested, just hear your overall. What are you seeing in the economy at the moment?
It's funny. We've kind of gone back and forth over the last 6 months, right? We started out with everybody just their hair on fire over tariffs and trade wars, and everything was going to fall apart and the world was going to melt down. And then we went through the summer and it was sort of like, oh, we got trade deals going on and the world didn't fall apart. The stock market is soaring again. So that must mean it was all just a big nothing. Now we're kind of going back in the wave downward again, where people are starting to realize, okay, maybe there was something to all that happened in April. Maybe the U.S. economy in particular is not in a great place. And even if the stock market continues to ignore all of the fundamentals, there are plenty of other areas that can keep us up and keep us up at night, looking forward to less than ideal circumstances moving forward. I mean, just the U.S. labor market. The U.S. labor market's a big one for obvious reasons, because for the last couple of years, everybody had said the U.S. economy is rock solid. I mean, that was the word that Jay Powell kept on using. In fact, it's the word that kind of really got him in trouble there, because he said the labor market was solid in July, just when the Fed decided they weren't going to cut rates. And then 2 days later, it's like, oh, okay. Payroll report for July comes out and the U.S. labor market no longer looks solid. And to his credit, he admitted that the U.S. is no longer solid. But that's just goes to show that some of the fears that were expressed back earlier in the year seem to be coming true. It's just that, in this cycle, even these downswings, they take forever to develop. And I know people have short attention spans to begin with. And we also have this picture in our mind that a downturn is something that happens over the space of a couple months. That was never really the case to begin with, but everything else is really is elongated and stretched out in this cycle anyway. So you put all those things together, it's like, okay, it's almost like we're stuck in mud here. We're going back and revisiting some of the themes that we thought we had put behind us a couple months ago, 6 months ago. Geez, it's been that long. But now it's okay. Now we need to start taking these things seriously. On the other side of things, the idea that tariffs were going to unleash this global inflationary wave, that kind of has settled down. Didn't happen for the same reasons that we're talking about the labor market. Businesses just don't have the room and the opportunity to expand and to pass costs along to their customers. So you don't get the tariff inflation, but you do have some tariff effect. In fact, the tariff effect that's squeezing margins, especially among smaller and medium-sized businesses, is one of the reasons why we're talking and focusing on the labor market so much, because businesses, they can't afford to just continue to take the hits on higher input costs and being unable to pass them along. What do you do at that point? You got to stop hiring workers. You got to start cutting costs. And so, like I said, it's almost like we're revisiting. It's like we've come full circle and revisiting where we were back then. It's just without the urgency. I think that's one of the key pieces that sort of got misinterpreted, was that the markets melting down, the volatility back in March and April sort of gave us the sense that things were imminent. There was there's a lot of urgency behind it. But now, 6 months later, we're still seeing the same macroeconomic case develop, just again more on the more elongated, take your time sort of time scale.
Yeah, and it's quite interesting, because I think if you look at the GDP numbers, they seem to be booming. It seems to be quite hot. Close to rise up to close to 4% recently. But as you said, there's also job numbers are quite weak. So it's quite an interesting dichotomy. And I think there's lots of people linking that to potentially immigration, potentially, let's be honest, Magnificent Seven. Their earnings keep increasing, but they're not really employing anyone. So really quite a unique economy. Is that what you're seeing, or do you think it is, as you're saying, just everything sort of finally coming through?
Yeah, there are a tremendous number of distortions in that respect, right? I mean, the certain parts of the stock market aren't represent. They certainly don't. I mean, the stock market and the real economy don't really represent. They don't really go together all that well to begin with. I mean, the stock market is whatever the stock market is. But in normal boom cycles, you would expect that businesses that are doing well, I mean, at least before 2007, businesses that did well got reflected in some stock prices. They at least expanded their own productive operations, and they hired people, and look forward to an opportunistic future. Whereas this AI bubble kind of get the opposite sense to it. They're building lots of stuff, that's for sure. I mean, a lot of big businesses are pouring tremendous amounts of dollars into AI infrastructure and build out. So that's happening. There is definitely some component in the real economy from the AI boom. There's questions about how much of that there is, and whether or not it can be sustainable beyond the current uptrend in the stock market, which I think a lot of people are correctly surmising that it feels and looks a lot like the .com transition, which means that once the rug gets pulled out of, in the short run, once the rug gets pulled out of the bubble, what happens to that one last economic pillar? So what looks like it should be a source of strength is actually kind of a questionable source of strength, suddenly becomes an avenue of vulnerability moving forward, because as we all know, these things go through historically validated patterns where you have a disruptive technology. Everybody jumps on it in the initial wave because nobody knows what it's going to do or what it is. We all go crazy over it, trying to be, the first one in on the ground floor. And then inevitably it goes way too far. People do way too many stupid things. There's too much stupidness going on, and the bubble has to reverse at some point. And then it kind of smooths out from there. Once you get past the initial phase, then you get into some sort of real adoption. But for the short run economy, you've got all of these negative factors that are potentially colliding at the same time. You've got a weak job market. It's a good point you brought up GDP, because we've had that same sort of dichotomy over the last really 3 years. GDP looks relatively solid. It's a little bit behind its 2010s trend, which is not good, but GDP looks like it's holding up relatively solid, at least in the United States. It's a different story around the rest of the world. But in the US, GDP looks okay, but where's the jobs? The jobs have clearly fallen off. In fact, the jobs may have fallen off and started, the US economy may have started shedding jobs, according to the gold standard for employment data. That's the QCEW. It really looks like the US started to lose jobs back in 2024. So if GDP is up here, relatively decent, and we're not creating jobs, there's definitely an economic disconnect somewhere. And it really comes back to the type of economic growth and the character of the current cycle, and how it's most of the employment was just front loaded into the first couple of years after the pandemic. And so we're just slowly grinding our way toward a future where, there's fewer people employed relative to the overall economy. And so it creates this impression that the economy is doing relatively well. We kind of feel it's not great. I mean, we know that there's a lack of hiring, but it seems to be relatively solid. I mean, you can kind of understand where Jay Powell was coming from when he kept saying solid, strong, and resilient. From a couple of statistics, it looked like that was the case. But that was always really the divergence between the labor market and output. Output is supposed to lead to increasing utilization of employees and among employers, businesses expanding their operations and bringing in new employees. But in this environment, it just hasn't happened. And so that acts as sort of a future drag on where the economy can go, because if you're not employing more people, you're sort of sowing the seeds of your own destruction, because eventually that comes back to be too much. It's sort of like, sort of like an economic scale. If you have too few people over here that are getting hired, there's not enough jobs in the economy. It just weighs down on everything. And eventually, even the output part of it ends up tipping over too. And I think that's what a lot of the markets are worried about, because the other side of this, I know you want to talk about this, Anthony, is sort of the leverage that's in the economy in a lot of different places too. I mean, one of the more popular topics, for good reason, especially the last couple of weeks, is a shadow banking and private credit. A lot of shadow banking and private credit, those two things are kind of the same thing, was predicated on the idea that the U.S. economy in particular, but the global economy too, were in relatively decent shape, so that a lot of these shadow banks, which are really just nothing more than investment funds, could take a whole bunch of risks because it seemed like there was no downside, or at least some limited downside that wasn't worth really paying attention to. But then you put the labor market that's shedding jobs into that equation, and suddenly now the credit markets have to take into account, first of all, maybe all the assumptions that were, that went into filling out the credits to really the credit system and some of these private credit conduits a couple of years ago. Now you've got, what's the real loss profile look like from that from that process, as well as, what are we going to go from here? What is the overall economy going to do as far as really forcing a reassessment and revaluation of some of these credit vehicles that have radically expanded over the last couple of years. And so it's not just a macroeconomic question, though. That's a big thing. I mean, we're talking about, losing jobs. It's not just a macroeconomic question. There are other components too. There's always a financial component too, but that's sort of the key ingredient and the key unknown is how do those two play out from here, and how do they play out on this elongated timescale that we continue to see?
Yeah, it's a great point because we, as you said, we saw sort of I think a few firms actually go into bankruptcy, and there's I think it was one of them was $40 billion of private credit on car loans, etc. So it does seem that this is, is this the first domino? Is this a risk for further sort of collapses? And I think everyone's seen that credit has been extremely easy to get through, buy now, pay later, or through other schemes as well. So you wonder, I think everyone's been saying, how long can this last? And, is this the point where it starts to slowly fall over?
Yeah, the real trigger is always going to be employment, because employment is the biggest factor in everything when it comes to, credit. I mean, whether they're talking about a residential credit or residential mortgage credit, which is not really that much of a problem right now. I mean, you've seen some delinquencies begin to rise, but as far as mortgage credit, I mean, delinquencies have been historically low for the last several years, really, it's largely because nobody wants to lend in the mortgage space. But it's not really mortgages this time. It's really the shadow banks that have moved into things like auto credit, not just subprime auto credit, even just prime auto credit. It is sort of, I hate to use the comparison, but you kind of have to. It's in a lot of respects, it's like the 2007, 2008 crisis. Not to the same degree. We're not going to see massive waves of banks failing. That's not really the issue here. It's that we have this relatively large space, private credit, that is untested. We don't really know what's going on in it, which, again, this should sound familiar in terms of 2007, 2008. So there's a huge amount of information asymmetry. And the risk is that you have an economy that seems to be at a real tipping point, no matter how slow that tipping point might play out. You've got an economy at a tipping point. And as we all know, I mean, just plain common sense, if you have a situation where the economy is shedding jobs, losing income, that's going to start to raise the number of defaults and delinquencies and all the bad stuff that goes along with credit market conditions. So you've got, the economy at a tipping point, that kind of future, and you have this unknown in the credit market, and it's a pretty substantial unknown. And the real wonder is how robust the credit market system is. And like I said, we haven't really tested these shadow banks. They really have not been tested in any serious way. You could argue, as I do, that we started to test the shadow bank system in April. In fact, that was one of the if not the primary source of volatility in the April event was private credit and shadow banks being challenged on their liquidity profiles in a really substantial way. But that all kind of just went away for reasons that people aren't clear over. Like I said in the introduction, where we're really going here is we're going back to that point and saying, okay, it seemed like we got away from it in April. We survived. Everything seemed okay. But then the economy didn't ignite. We started to get more questions about the labor market, which in the financial space raises in really larger questions about the real conditions in all of these huge private credit conduits and vehicles that are out there, and not just in terms of default probabilities, but also liquidity characteristics and how solid that is. And so there's a bunch of questions that really we don't have any real solid answers. And you mentioned a couple of things that popped up, Tricolor being one of those, the subprime auto lender in Texas. Just last week, First Brands, which is an auto supplier that had been factoring a whole bunch of their business. I mean, a huge amount of their business. You have to wonder, we don't really have the whole story behind that one. So yeah, there's definitely an auto business component, which is not really a surprise given the fact the auto business never really recovered after 2020. And then you throw onto that all of these other credit questions that come up, and we all know there's massive amount of leverage that's been applied in all these places. And I think factoring is going to be one of those other factors that a lot of people are going to be looking at going forward. And so you put these things together. Okay, is Tricolor and First Brands, along with the losses in the job market, especially even the establishment surveys showing that we have negative monthly payrolls back in June, very very likely negative payrolls in across the summertime. And is this really the tipping point where we start to really reevaluate and look at and take a closer look at everything that's been happening over the last couple of years? Is it finally reaching that point where we start to really ask some serious questions?
Yeah, but it sounds like there's so many distortions that this could continue for 6 to 12 months potentially until we actually really get that proper data coming through.
Well, I mean, the counter argument to everything has been, okay, we've been asking these questions for years and nothing seems to happen. I mean, go back to commercial real estate in the United States. We've been talking about a commercial real estate bust for several years for obvious reasons, because it really was a commercial real estate bubble. It got way out of control for basically stupid reasons, rationalizations everywhere, irrationality being applied. Everybody thought the economy was red hot. It was recovering and it was going to stay that way forever into the 2020s and into the future. And it turned out to be not the case. But yet, where is the shakeout? So you can kind of understand the counter argument is, okay, yes, there's all of this leverage, there's all of these potential losses, but maybe it doesn't really matter all that much because nothing bad has happened up to this point. I think, Anthony, to your point is we really don't know. We really haven't seen any kind of shakeout start. And commercial real estate start there. Commercial real estate has been in an extended pretend regime for the last several years, to the point that everybody operating in the space is doing everything possible to avoid anything like price discovery. It's been completely frozen out, shut down, in complete stasis. And the idea is that, you extend and pretend until the economy starts to pick up again. We get into a recovery situation. Then you can start to unwind everything. And, we all know there's going to be losses that have to be taken, but you unwind those losses in relatively orderly fashion under the most, ideal circumstances, really sanguine circumstances. That's the point behind extend and pretend. But the longer you go and you don't get the recovery, you don't get the acceleration of the economy, the more questions that arise against that, the more data that says that maybe the U.S. economy is getting worse, not better, that raises the chances that extend and pretend stops doing the extending and therefore has to stop pretending as well. And that's just commercial real estate. So there's a tremendous number of questions, not just about what might happen, but also, is there really some sort of trigger that can finally focus everybody's attention on trying to get some answers behind not just, we all know there's going to be losses in these parts of the economy. It's when does it become an issue that really starts to impact more than just some stuff around the edges? When does it become a real meatier issue that maybe even the mainstream or the stock market actually has to pay attention to? And unfortunately, that's a question we really can't answer. We still can't answer to this point because we really haven't seen anything that suggests that the system itself is really willing and being forced to take a harder look at all of these imbalances and distortions. That's a really good word to use. All of these distortions across the credit markets as well as the real economy. It's almost like if nothing forces people to do it, everybody will love to. It's the ostrich strategy. Just keep your head in the sand and just hope for the best. So long as you're not forced to sell anything, why not? Just keep riding it as much as you can.
Yeah, it seems, as you said, there's been a bit of an everything bubble where basically almost all assets, bonds have been coming, their yields were going up, but now it sort of seems to be coming back. So that seems to be something that has been happening. There's just things continue to rise, and that's probably keeping, sentiment going because a large majority of US people are invested in the stock market. So as long as that keeps going up, they're becoming wealthier and wealthier.
Yeah, it's also that for the public anyway. When you talk about how do people view the economic circumstances? Most people get their information understandably from a couple of sources. Number one, hear Jay Powell. If Jay Powell talks about the economy, you must know what he's talking about, not realizing he has every incentive to lie to you, which he often does. So if Jay Powell says the economy's solid, who are we to say otherwise? Because there's, this idea, don't fight the Fed, which, by the way, the markets fight the Fed. In fact, the markets like to bet against the Fed all the time. But, there's this public idea, you don't fight the Fed. Jay Powell says this. And then the stock market is roaring. And we're taught that the stock market is the most efficient and the most productive discounting mechanism for macroeconomic circumstances and information. So if the stock market is soaring, then the economy must be fine as well. And those things are just myths. Those are just legends that everybody tells themselves because, frankly, nobody has the time to sit down and really focus on what's happening in the macroeconomy to begin with. So you naturally and understandably pare your focus down to a few variables and say, okay, the stock market, Jay Powell, GDP, and maybe the unemployment rate are the few things that I'm going to look at. And if those things look relatively decent, then that's it for me. That's good enough for me. It's not quite the case in terms of credit markets. Credit markets, because credit markets are anchored to reality, because you've got a maturity, you've got cash flow, you've got interest payments to make. Can't afford that luxury to be an ostrich. So credit markets have been saying for the last several years, and hedging with increasing emphasis, that at the very least, interest rates are going to go down by a lot and stay there for a very, very long time. So the markets have been saying since 2023, really 2022, but in more and more certainty since 2023, really in the aftermath of the banking crisis. In fact, there's a couple of things that say the banking crisis really plays a huge role. But I mean the 2023 banking crisis. That's another myth that people have. The Fed handled the 2023 banking crisis. We suffered nothing from it. We're good to go. We're good to go. They saved everybody, and moving forward. That's not the case either. The market's made a huge change in 2023. Like I said, betting more and more emphatically that interest rates are going to go down and go down by a lot and then stay there for a very long time. And what that tells us is, there's not a lot of good scenarios that lead to rates going down and staying there for a long time. We're talking like, aftermath of 2008. So, we have to figure out what that means. Does that mean that, the economy is going to fall off 2008 style? We're going to go through some kind of crisis. What is it that the market continues to hedge? And again, I'm not talking about the stock market. I'm talking about the vastly more important and vastly larger monetary and financial markets, fixed income, credit. Participants in those markets have been saying, no matter what has happened over the last couple of years, everything that comes along is that not only do we believe that the rates are going to go down, we believe it even stronger every time something takes place. So we have to figure out what it is that leads to a situation where rates go down, they go down by a lot, and they stay there. And I think one of the things that people have started to realize that along those lines is that central banks, at least outside the Fed, central banks are supposed to be higher for longer. For years, they said, inflation was our greatest risk. And over the last year and a half, they've been cutting rates pretty aggressively. So even central bank policy rates are starting to get with the same program that the markets have been saying, forecasting low interest rates well into the future. Even central bank policies are starting to align themselves with that prediction, that forecast, and that betting too. So we have to, that's really the job that we have, is to look around at the current circumstances and say, what gets us from where we are today to that long run future? Because as we move along, more and more, not just the US, but around the rest of the world is aligning with that, it's not a hurry, it's not a rush, it's not maybe on the normal time scale that people have in their minds, but slowly over time, incrementally, you can see how the world is progressing toward that future where rates going to go down by a lot. We don't know what that is. So you look at the credit markets like we were just talking about. Could it be the commercial real estate bubble? The extend and pretend finally, is forced to some price discovery. Could it be something that blows up in the private credit markets? The shadow banks run into some troubles. I think that's one of the reasons why Tricolor and First Brands have kind of picked up a lot of people's ears here, is because it's, that's consistent with maybe unleashing a couple dominoes that get us more into that direction of a future where rates go down. But we still, like you said, we still don't have any sort of confirmation. We still don't have this sort of concrete roadmap that we could follow that says, this is where we are today. We kind of know where we're going to be in the future, what tomorrow looks like. And now we're starting to get a better sense of what that in between is, what I call the last mile in the economy. And it's still just, unfortunately, still just a lot of conjecture. You hope it's reasonable conjecture. You're drawing conclusions based on the information you have, but we always know that we don't have nearly enough information. It's given the nature of the system as it is, it's always opaque. But more and more, you can see how we get to that long run future.
Yeah, and I imagine, interest rates decrease by the Fed, quantitative easing, when that comes through, will decrease, yields. You imagine, at least government yields, you'd imagine that would be the case.
Well, those things actually come along afterward. The Fed is always reacting to what the market has already done. So QE doesn't lower yields. QE comes afterwards to try to get people to believe the Fed is doing something important. And that's the other thing. Lower interest rates are not good. They are not stimulus. Low interest rates reflect a high degree of demand for safety and liquidity in the marketplace, which the opposite of what's supposed to be stimulus. If everybody's in demand for U.S. treasuries and government bonds, the last thing they're going to be doing is the sort of risk taking that you need in a recovery. So QE is really nothing more than a magic trick. It's a puppet show to try to get people to believe the Fed is being somehow stimulative when all the Fed is really doing is reacting to the same thing that brought interest rates down to begin with. So the market, like I said, the markets are already anticipating low interest rates. And if the Fed does QE, that's not going to create stimulus. That's just going to confirm what the market has been saying all along. If the Fed is panicking to the point that they feel they need to do QE, the market's going to be like, yep, see, we told you, this is what's going to happen. So QE doesn't lower interest rates. It's the last measure of confirmation that the market was right about why low interest rates were moving lower to begin with. But I do think that's the direction we're moving toward. And a lot of central banks have said they're not going to wait till they get to the zero lower bound to try to do QE like they did in 2007, 2008. They're going to try to use it as sort of the regular toolkit to try to reignite and spark some of the animal spirits in the real economy and the financial markets, even though that's not what really happens. And QE is all just, it's all just noise anyway. But you're right, it's part of the process here. If the market is correct about where everything is going and yields do want to go lower, then eventually the Fed and the ECB and everybody else will do the same thing. They'll drop rates down to the ultra low territory. They'll probably do some QEs, and that will just confirm what we just talked about, what the market has been saying all along. We did get to a situation where whatever that is was enough that even central banks feel they have to deploy their big guns, even though they're not really big guns. But if central banks feel they have to do something big, that just confirms that why interest rates gone low and how likely they are to stay low into the future. Like I said, the problem is the counter argument is here we are in 2025 heading into 2026, and we still don't see anything that says this is absolutely going to happen. This is going to take place. This is how we get there. And again, the counter argument is we've been talking about this for years. So you get into sort of that recency bias. If nothing bad has happened, nothing bad can happen. And that's really, I think, the mistake that Jay Powell was forced to confront, where he kind of, he kept saying the U.S. economy was resilient. The labor market in particular was resilient. Now he realizes it wasn't resilient. And if you extend that analogy beyond just, the employment statistics to the overall economy, and then maybe the credit markets beside, where you thought they were resilient, and then all of a sudden you realize maybe they weren't as resilient as you thought. And that's really where the bankruptcy behind Tricolor, though we still don't know the story there. Tricolor might be just fraud, like the banks are, Fifth Third has said it's fraud. But First Brands, factoring, some other credit market, what we went through in April with the shadow banks, there's enough that suggests that the resiliency isn't there either. And if the system is forced to confront some real challenges for once, there is concerns that it's not resilient, that there are avenues for contagion and fault lines across the system, which could lead to bigger problems than what we saw in April. And that would certainly get us to that final piece where interest rates go down by a lot and stay there. But again, we don't know. We don't have that information.
Yeah, and it does seem like, and maybe this is a shift in a completely different direction, but the recent rise we've seen in gold, it does seem like there's sort of a perspective. Also, there's obviously positioning that people think that there's risk on the horizon. Obviously it could be international central banks buying, but the rise has just been astronomical. One of the best performing assets this year.
Yeah, gold is definitely a signal there. It's the ultimate financial hedge. And yeah, other central banks are buying gold, which, you got to ask why. Why are other central banks buying gold? It's not because they're replacing the dollar. I know that's what a lot of people will say. Oh, they're getting ready for a gold-backed currency. No, that's not even possible. They're buying gold for a reason. And it's not just foreign central banks either. There's a lot of people around the world who can sense that there is a lot more negative potential than there is positive potential, especially when you put gold together with copper. The copper to gold ratio is a historically validated inflation versus deflation signal, to break it down into very generalized terms. And the copper to gold ratio is at a record low or very near record low. It's been hitting record lows, which is not a good sign. And when you say that, a lot of people say, oh my God, does that mean we're going through another 2008 again? Because the copper to gold ratio is below where it was in March of 2020. It's below every single day in 2008, 2009. Does that mean the market is saying when you put copper together with gold that it's expecting a crash? Really, the record low copper to gold is just like low interest rates into the future. They're basically telling you the same thing. The market is preparing for lack of upside and a whole range of potential downsides. But, again, it's not like somebody goes on, there's not like some website that we can go to that, everybody who's been investing in copper and gold tells us why they're hedging using gold. We have to sort of infer into these market prices and in these changes what it is that these markets might be afraid of moving into the future. Like we don't have that information. We don't have enough information about that, but we do have enough sense of how things have progressed over the last really year and a half, going back to around March and April of 2024. You can kind of see things be really, I hate to use the word accelerate, but because, if you're going along at 2 miles an hour and you accelerate to 3 miles an hour, that is acceleration. That's kind of how it feels in the real economy. But there has been some acceleration to the downside in a lot of different ways. It's not just related to tariffs and trade wars, just the lack of forward momentum across the entire global system, rising unemployment in a whole lot of places, including the United States. So there is enough information that suggests that we're moving in the wrong direction, even if it doesn't tell us exactly how we get to that last mile period. But again, that's consistent with a copper to gold ratio that keeps going lower and lower and lower. That's the market more betting on the gold side of it, less on copper. Which, copper being a real economy, physical commodity. If, the economy was picking up, we would expect copper prices to vastly outperform gold, but it's been the other way around. So, everything that we're getting, including fears over maybe some credit market dust up, would be consistent with a copper to gold ratio that keeps going down and down and down, consistent with lower interest rates. So there is a lot of that consistency, even if we don't have the full complete picture of what that looks like in the end anyway. Not that we should expect that to begin with. I know that's one thing I do want to mention here is that you go back to 2008, it was kind of the same progression. It wasn't until, Lehman Brothers really failed, really AIG, that anybody really had the sense of what was going on. It was still kind of the same thing. I mean, you go back to 2008, people in the middle of 2008, the Federal Reserve in the middle of 2008, didn't even think the U.S. was going to experience a recession that year. They thought that Bear Stearns represented the absolute bottom. That was the worst case. And it really didn't become absolutely clear to most people until the fall of 2008. I think the credit markets had a better sense. But even in 2007, leading up to Bear Stearns, there still wasn't that sort of, that clarity, that sort of daylight that suggested this is exactly what's going to happen. It really took quite a way to get there. So in one sense, what I keep saying, we don't have the information. We shouldn't necessarily expect to have that information in that way. That really comes with hindsight, which makes everything incredibly more difficult. But I think the overall message here is that the markets that are forward looking continue to look forward toward this rate, sort of like copper to gold and low interest rates. And whatever it is that gets us to that point, we keep moving in that direction.
Yeah, definitely. And it does seem like the dollar is the one that's sort of really been taking the hit in terms of where things have sort of been, I guess where not the pain, but where it has been sort of going out. It's the dollar's sort of depreciated against all other fiat currencies.
Well, the dollar's actually going back the other way as we would expect. If we get to this future where we have certainly liquidity problems, the dollar's going to just go screaming higher. I think there's a lot of misconception of what the dollar exchange value has done over the last several months anyway. First of all, it's the focus on DXY. DXY, which everybody uses as the stand-in for the dollar. It's not. DXY is a stand-in for the euro US dollar exchange value. And even that is overstating things a lot to begin with. But you look at a number of different currencies and you can see the same thing. The dollar made a huge move, and I mean huge move last year, which was consistent with rising illiquidity across the system, more safety and liquidity demand, interest rates, steepening on yield curve, bull steepening on yield curves. That's another thing people get wrong, what's going on in the yield curve. So you had a major dollar disruption last year, which sent the dollar soaring higher. In fact, it soared to extreme values. Even DXY got up to, I think it was close to a record high, when some of the other broader trade-weighted indexes did set record highs, especially the trade-weighted index against emerging market currencies, which definitely hit record highs, which is consistent with a period of tightening dollar conditions. We got to extreme levels in April, as you would expect, given the disorder and chaos. And then after April, all that happened was the dollar relaxed from those extreme levels. So the dollar was way up here. indicating extreme illiquidity, extreme levels of fear and risk aversion. Then they came back down a little bit. The DXY was accelerated and amplified because the euro went down more than others. And everybody said that was sell America. It wasn't sell America. You look at currency after currency after currency, all that happened was the exchange value retraced to where it had been before the big spike in the US dollar that started late last year. So like the Canadian dollar sunk way down to not quite a record low, but it sunk down to around 2020 lows. And then it came back up. It wasn't a weak dollar, weak US dollar. That was the US dollar, Canadian dollar exchange value going back to where it was off of the extremes from March and April. Then we got to July, and you can see this in a whole bunch of currencies, including the euro. The euro hasn't been going up at the same rate as it had before. But you look at all these other currencies, Canadian dollar, New Zealand dollar, Indian rupee. Indian rupee is a big one. Korean won, a whole bunch of, even the Japanese yen. The US dollar is making starting to rise again ever since the early part of July. And some of these currencies are sinking down to not just multi-month lows, but getting back to where they were closer toward April rather than something like the US dollar falling in value. So the dollar is actually making an upswing here, and it's starting to accelerate higher in some of these key currencies, like the Indian rupee continues to hit record lows. The South Korea won, which was sort of a measure of potential for tariffs and trade wars and the negative impacts that those might have. The Korean won is back below 1,400 to the US dollar, despite the Korean government intervening at the end of August. So the US dollar is moving higher again, which would be consistent with a world that is moving toward low interest rates and low copper to gold deflationary environment. And so if we see the dollar continue to rise, which I think it's starting to signal the next stage in this cycle playing out, again, it gets us closer to that end point where we get into that last mile situation. And if we do have, not just U.S. shadow bank credit that starts to become more and more questionable, but more global credit profile that becomes more and more questionable, you'll see the dollar continue to go up in exchange value, which is not a good sign. Has nothing to do with politics. It has nothing to do with all the mainstream narratives about what the dollar is doing. The dollar going up is just a financial bellwether. And if the dollar's going up, that just means tighter financial conditions. And if it goes up by a lot in a very quick-paced fashion, that tells you that there's more of acute negative financial conditions.
Okay. Yeah. Really interesting. So I guess, there's been a lot of doom about, obviously shifting away from the dollar system, from, I guess, the Eurodollar and what's happening. It sounds like you don't think that's the case, and things are sort of, the monetary system is remaining quite similar to what it has been previously, and it's going to continue like that in the future.
Yeah, nobody's moving away from the US dollar system. It's not because of politics. And I know there's a huge narrative, especially in the crypto community, that this has to happen because something needs to justify Bitcoin or whatever cryptocurrencies, when stablecoins are actually taking over anyway. But the point is, the US dollar, the US isn't going anywhere. We've heard this for 20 years. Everybody's been saying the US dollar is being replaced, and the people who say that have little idea how the US dollar actually works. They actually think it's some kind of government currency. It's not a fiat currency. It's a bank currency. It's a bank-centered currency, virtual currency, whose functions and performance is not easily replicated. So for something to take over from the Eurodollar system would require, at the very least, at the very minimum, being able to do what the Eurodollar system does. And the thing is, nobody knows what that is. So everybody who's running around saying the dollar is being replaced and the world is selling dollars, they really don't know what the dollar needs to do or how it gets done, which is why they've been wrong for 20 years and they're wrong now. Nobody is moving away from the dollar, and that if these fluctuations in the exchange value of the US dollar tell you something about conditions in the US dollar, not some kind of external move away from it. So if we see the dollar fluctuating up and down in short run periods, you probably want to dismiss those to begin with, because short run, lots of stuff happens in the short run. But you look at it from a intermediate and longer term perspective, the dollar continues to go higher against all these proclamations and predictions, because conditions continue to get tighter and tighter and tighter. Why did the dollar surge like I said, at the end of last year? Because conditions got tighter and tighter and tighter across the rest of the world. Even if it didn't lead to a stock market crash until April, stocks have little to do with functional liquidity across the entire dollar system to begin with. So no, nobody's moving away from the US dollar. It's not like there's some tremendous international push to create a BRICS currency. By the way, that's never going to happen. There's never going to be a BRICS currency. It's just something that people use because they think it has to happen. They think that the U.S. government has gone too far in a number of different ways, whether it be political partisanship. First of all, you got to step back. You hear this every administration. We heard it for 4 years during the Biden administration. Biden was weaponizing the dollar with all of its sanctions. Therefore, the world was going to ditch the dollar, and it never happened. Then the Trump administration comes in with its tariffs and trade war. Oh, now the Trump administration, everybody's going to ditch the dollar. Everybody is always ditching the dollar, except it never actually happens. And the reason it doesn't happen is because there are functional requirements. So you got to move away from trying to interpret politics, whether it be partisan politics or geopolitics in the movements of these exchange values. You realize that they're telling you something about conditions within the system that is not changing anytime soon. And that's not actually a good thing.
Yeah, no, great point. And how do you see stablecoins impacting this? Because I guess it's almost, from the way I see it, and maybe I'm looking at it wrong, it's a way to increase liquidity basically without paying a yield. So it seems like that's the way that they're going to go about this. But yeah, how do you?
Well, you just hit upon their own destruction. Stable coins are going to be sort of like a bridge to get people more into digital currencies and digital money. But stable coins, as they're currently construed, they're gone. They're dinosaurs. They're already out of business. As soon as money market funds figure out the technology and the way to do it, money market funds are essentially stable coin. A reserve stable coin is nothing more than a money market fund, except the money market fund has equity with limited transactional value, whereas a stable coin is basically a money market fund with a tradable token. So once the money market funds, and we're talking about the biggest financial companies in the world, BlackRock and Fidelity, and all the other ones, once they figure out how to make a money market fund and pair it with instead of an equity share, instead of giving an equity share, you get a token. So you got a money market fund with a token. You don't need stable coins. You basically have stable coins that pay a yield. And since stable coins can't pay a yield and money market funds can, it's just a matter of time before those two things happen. But you're right. I mean, money market funds are essentially not money market, stable coins that will become money market funds. Stable coin money market funds, that's the future. And they are a way to not just create liquidity, but also to expand and make the current payment system a hell of a lot more efficient and productive, which are net positives. So stable coins are actually helping the system to do what it already does, but do it in a better way. But that's not necessarily moving away from the US dollar system. In fact, in many ways, stable coins and money market funds would be an extension of the current system, extending it farther into the future, farther into our digital future. And therefore, really doesn't represent anything more than a transformation of the current methodology and extending it into sort of more the digital cryptocurrency format. So taking the current Eurodollar and making it a digital Eurodollar. Even though the Eurodollar already is a digital Eurodollar, but beyond strictly the banking cartel that runs the current Eurodollar system, which to me would be a huge step huge step forward and a huge positive moving forward into the future. Unfortunately, that you have to wonder about how limited the reach of stablecoins might be in being able to really fully transform the Eurodollar system into something much bigger, better, and more efficient overall. Integrating a lot more than just payment needs, which are very important, no question. But the functions that the Eurodollar system performed go way beyond just managing payment requests across vast networks. There's a lot more that goes to it. So in that sense, the stable coins that help transform the Eurodollar toward this more digitized future. Again, even though the Eurodollar is a digital currency, but into the more recognizable as what people imagine of a digitized future. It does extend the life of the Eurodollar system quite a bit more, which in many ways could be positive, but also I think, I would prefer we start from scratch with something else, but many times you don't just go from A to B. There's usually a process and there's usually several steps along the way. And so maybe stable coin adoption and money market fund coin adoption will be an intermediate step before we get to that long run future.
Yeah, really interesting. So, Jeff, thanks so much for your time today. Really appreciate everything we touched on. But my last question is, what is one message you want people to take away from our conversation?
Yeah, just figure out what that last mile is. Look, like I said, as slowly as the cycle has progressed, it is still progressing, and it is still progressing in that same direction. So realize what the markets, and I mean the vast majority of the markets have been saying, is that rates are going to go lower. They're going to go down by a lot, and they're going to stay there for a very long time. So I think most people should understand that message and and more so where it is coming from. It's not coming from me. It's coming from the vast majority of the real marketplace, and be on the lookout for all of these signs that could potentially tell you how we get from where we are today to where this future, what this future looks like just who knows how far down the road. Because the further we go in time, the more the data aligns with it, however slowly, and the more the markets are sure this is going to happen. So I think that's the one message, is be on the lookout for what it is that might get us to that last mile, or get us through that last mile to where this long run future shows up.
Yeah, great message. So thanks again. If anyone want to find out more about your work and what you do, where would the best place for that be?
Yeah, just check us out at Eurodollar University. I'm actually having a webinar in a couple of weeks on this this topic, the hidden information that we get from interest rates that that the mainstream economics really does not give you. Mainstream economics gets so much back where it comes to finance and interest rates, and especially monetary topics. So one of the things I try to do every once in a while, every quarter, we do a webinar to try to really get into some of these topics about, what are these pieces of information? How do we interpret and decode them? And so got a webinar coming up on October 14th. So you can check that out at Eurodollar University as well.
Great. I'll put that all in the description, but thanks again for your time.
Yeah, it's good to see you again, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.